that's basically the distribution by wage. And you can see, and that's something that we indicated already last year, and it's happening more and more, that this is the most asymmetrical recovery ever in Canadian history when it comes to the wage distribution. Basically, almost all the jobs created were high-paying jobs. In fact, the one that is down, it's between roughly 30 to 60,000, significantly down. So we are seeing a situation in which this asymmetrical nature of the recession is something that has a lot to do with the performance of the housing market in Canada over the past 2 years. We will get into the housing market later, but just let's discuss it for a second because I think it's important to understand. People are asking, how is it possible that the housing market has been on fire despite the fact that we were in a recession and COVID? And the answer is this chart, the asymmetrical distribution of job creation. You see, all the jobs that were lost among young people, low-wage individuals. Most of them were renters. For home buyers, potential home buyers, COVID was not an issue financially speaking. In fact, the opposite is the case. They are better off because their savings rate went up, as we discussed in the previous presentation with this mountain of cash that people are sitting on. So you have a situation in which a huge segment of the population was unimpacted by COVID, financially speaking. So if you think about it for a second, you get the benefit of a recession vis-a-vis extremely low interest rates without the cost of a recession vis-a-vis a broadly based increase in the unemployment rate. Usually when you have a recession, interest rates go down, but also the unemployment rate goes up, and it's broadly based, so job insecurity is out there, people are not spending, clearly they are not buying houses. But when your job is there, it's secured, your income is there, and interest rates are in the basement, that's the opportunity that you were waiting for. And that's why there was this sense of urgency to get into the market. That's exactly what happened in the housing market, is still happening. So this is the environment, the virus, the economy, the labor market, where we are. However, clearly we must discuss the most important issue impacting us at this point, and that's inflation. Now, granted, if you are under the age of 30, you don't even know how to spell the word inflation, but we have to recognize that it's happening. So let's go to the next chart and see what I mean by that. This is GDP. As you can see, in real terms, in the second quarter, GDP was down. But in nominal terms, namely after inflation, it's up by 8%. And given the fact that government revenues are based on nominal GDP, Trudeau is much richer than he thinks. And even in Ontario, we have seen the budget deficit half of what it was supposed to be because of this huge increase in nominal GDP. Why? Because of inflation. So the key question is, how much sleep should we lose over inflation? You read the newspapers, you know that it's controlling the agenda at this point, the inflationary fears, and we have to discuss it. Let me start by telling you one thing, and I'm very clear about it. Nobody knows where inflation will be 6 or 8 months from now. Nobody. And when I say nobody, I include the Fed and the Bank of Canada in that nobody. Nobody knows. People are pretending, but nobody knows. That's the reality. So the question is how you deal with it and what kind of policy you activate given this uncertainty. In order to do so, we have to go deeper and see the source of that inflation and try to guess how sustainable it is and to what extent it is all COVID related. Let's go to the next chart and start this exploration. First, everything, 100% of inflation that we are seeing now, 100% is COVID sensitive. Basically goods and services that are related to COVID. And when we woke up, the gates are open, that's where you see the inflation happening in services and goods that are linked to COVID and that were shut down, and the pent-up demand is being utilized, leading to inflation. That's one thing. The second chart is the wage aspect. That's the next chart. and we are seeing the wage aspect of COVID. Can we go to the next chart? Or yes, thank you. And you can see that the wages are rising. That's going back to the issue of people coming back to work or not. Now, go to a restaurant, go to a hotel, even in aviation, you cannot find people. You simply cannot find people. In the US, people are quitting like there is no tomorrow. The vacancy rate is at a record high. Regardless what you do, you cannot attract people. How do you try to attract them? By paying them more. And until recently, many young Canadians were sitting at home, collecting government money, and watching their future wage rising. And the big question is, how many of them will go back to the labor market the minute you don't have this check coming every 2 weeks? And I believe that some of them will, but again, you go to some states in the US that are ahead of us, and you see that not all of them are coming back. And there is another issue, and that's people over the age of 55. Especially in the US, we have seen a situation in which many of them decided to exit the labor market during COVID. And I'm telling you, if you are over the age of 55 and you decided to exit the labor market during COVID, you are not coming back. Which means that this shortage of labor can be with us for a while. And when there is shortage, people are paying more. Wages are rising, and that's inflationary. And when you have wages rising, you don't see them going down anytime soon. So that can be inflationary for another year, something to take into account. And then you have the next chart, which is supply chain. Listen, economists have many, many faults, but amnesia is not one of them. We all remember the 1970s. And the question is, to what extent the supply chain issue that we are facing is basically what we have seen in the 1970s and the stagflation of the 1970s with lower growth and higher inflation. And I suggest something very simple. Comparing today's situation to the 1970s is not only wrong, but also irresponsible. This is not the 1970s by any stretch of the imagination. Back then, interest rates were in the sky. Today, they are extremely low, too low. Back then, the baby boomers were consuming like there is no tomorrow. That's not the case now. And back then, the level of debt was much lower than it is now, which means that the sensitivity to higher interest rates was not as high as it is now. You cannot compare today's situation to the 1970s. However, the big question is it supply or demand? What's causing this issue in which you have to mortgage your business to get a container from China? What is the number one issue here? Let's go to the next chart and discuss. This is durable goods in the US, the chart to the left. So you can see that you're still way higher than you should be. Services are almost back to where they should be, but goods are 20% higher relative to the trend line, which means that in a very short period of time, overnight, economically speaking, you got this demand boom. People buying like there's no tomorrow. Why? Because you click a button and you get what you want. Or at least you're trying to get what you want, but you're ordering. So you get your exercise bikes and all the things for the house. We all know the story. And it's still there. It's not going down dramatically, which means that you get this demand shock, 20% overnight. And I'm saying this kind of huge increase in demand can challenge a supply chain system that is normally functioning. And this, of course, is not a normally functioning supply chain system. It is sick because of COVID. You can see why it's so important, because the market is getting nervous. The market was expecting that by now the supply chain issue will not be an issue. And now all of a sudden the Bank of Canada is telling you, you know what? Remember I told you that it would be over? We were just kidding. It's not going to be over anytime soon. It will be well into 2022. And the market said, yes, in this case, I'm adjusting my expectations. Today, the market is expecting the Bank of Canada to move no less by 6 times in 2022, starting as early as March or April. This is a very aggressive market pricing. Until recently, the market was talking about the Bank of Canada moving in 2023. Now they're talking about early 2022, 6 times. That's a very aggressive set of expectations coming from the market, and the 5-year mortgage rate is smelling blood and is rising now, reflecting this kind of expectations. That's more or less where we are now. Granted, what the market is expecting doesn't mean that that will happen. That is just market expectation. And the question is what the Bank of Canada will do. And this is very important to understand when you discuss it with clients about interest rates. Very important to understand. The Bank of Canada and the Fed, as I suggested earlier, they don't know where inflation will end up. And there is an issue, because inflation is a lagging indicator. So when you wait and wait and wait and wait, you will be behind the curve. And what is the most important asset of a central banker? The most important asset, it is its credibility. And if you tell people, don't worry, be happy, inflation will disappear tomorrow, and it doesn't, you lose your credibility. So the Bank of Canada is facing a credibility dilemma now. If you wait and wait and wait, you risk losing that credibility and being behind the curve on inflation. If you start early, you basically show that you are in charge. So when I communicate with the Bank of Canada, and I see them very often, unfortunately, I tell them, listen, start early, no issue here, but you don't have to go 6, 7 times in 2022. No need. Absolutely no need. You can go 2 or 3 times, you will establish your credibility, but you won't shock the market because, and that's very important from your perspective, what is the enemy of the real estate market and the economy in general? What is the enemy? The enemy is not rising interest rates. The enemy is rapidly rising interest rates. Because every economic recession over the past 50 years was helped, if not caused, by a monetary policy error in which central bankers raise interest rates way too quickly and shock the economy. So I say, take this, cut it by half, and continue moving in 2023. I see the market ending up taking rates to about 2% in 2 years, 2.5 years, from 25 basis points. So it's a significant increase, but slowly. That will be the right thing to do. If you move to 2% over the course of breakfast, you will shock the economy. So the key issue here is not how high interest rates will rise, but how quickly they will rise. And I believe that the Bank of Canada gets it. I believe that the Fed gets it. They would like to avoid repeating past mistakes. So a reasonable scenario, they will start in April, maybe July, depends on the COVID situation, and they will go 3 times in 1 year, and then another 3 times another year. Take it slowly. That would be the most reasonable thing to do. And the market, I think, is mispricing how aggressive the Bank of Canada will be. Now, given that, and given the fact that we are talking about interest rates, we have to discuss the real estate market and the impact of higher interest rates on this interest-sensitive sector. So let's go to the next chart and discuss. We got today's number from Korea. The numbers are up again. We have a monthly sales, so in terms of units, at about 54,000. Just to remind you that before the crisis, the average was about 40,000. During the crisis, it went up to about 70,000 per month, and now it's back to 50, 55. So it's down, but it's still 10, 15,000 units higher than it was before the crisis. That's one thing. It will get even stronger than that over the next few months. Why? Because of higher interest rates. And you ask, how is it possible that higher interest rates will lead to higher activity? It's always the case, as you know. Because whenever people smell higher interest rates, whenever the Bank of Canada tweets about higher interest rates, the minute the market is thinking about that, people get into the market to make sure that they lock those extremely low interest rates before they go up. And that's exactly what we are seeing. We're seeing activity accelerating, we see mortgage activity accelerating, and that will continue over the next few months. In many cases, what we are doing now, we are basically borrowing activity from the future. So if you go to the next chart, you can see what I mean by that. The market is actually not a normally functioning market. It's still very, very tight. You go to the next chart, and you can see what I mean by that. There is no inventory. So the supply issue is very, very limited. We all know the story. There is no supply. So the fundamentals of the market are very, very strong. The market slowed down over the past few months, especially in the low-rise segment of the market, not because of the fact that it's weak, but because of the fact that it's strong. It was simply operating at 70, 80,000 units a month. You have to go back to about 50, but 50 is higher than it was before the crisis, and now it will accelerate again ahead of higher interest rates. So we see activity accelerating over the next 2 to 3 months and then starting to stabilize. But a lot of other things are happening in the housing market that we have to understand and appreciate. Let's go to the next chart and see what I mean by that. First of all, this narrative of people fleeing the city. Remember the Toronto refugees, the Vancouver refugees during COVID, that everybody left Toronto, bought all kinds of houses in the suburbs. Of course it happened because it was before the crisis, and this trend was accelerated during the crisis. However, you look at this chart, and you can see in the example of the GTA sales in Ontario, the share did not go down dramatically. You go to the next chart, and you can see that the next one, you can see that share of home sales within 300K of GTA was basically 5%. All the rest was the GTA. So what I'm saying, clearly people were trying to take advantage of working from home and get cheaper property outside Toronto. But it's 5% of sales, which means that Toronto is still the center of the universe. And if I'm right or even semi-right, this trend will slow down and might even reverse a little bit when the city totally opened up. So that's one aspect, just to put it in perspective, because I know that there was a lot of media about it. The numbers suggest that that was a marginal story, not a big story. The next chart is telling you another story. And that's something that until recently was just at the margin, but you in the profession must understand that this is happening and this is a game changer. And here I'm talking about gifting, namely parents gifting towards down payment. I just released a paper just a few weeks ago quantifying the amount, and this is very, very significant. 1/3, almost 1/3 of first-time buyers are now receiving a gift from their parents. The average gift in Canada as a whole is $80,000. Now, that's not all. Mover-uppers, 10% of them are also getting a gift. And the average is much, much higher. Just as an example, the average gift for a mover-upper in Toronto is about $260K. In Vancouver, it's about $340. That's not an insignificant amount of money. And as you can see from the next chart, that gifting is dancing to the tune of home prices. Whenever home prices slow down, gifting slows down and vice versa. COVID accelerated the process of gifting for two reasons. One, low interest rates. Parents basically told their kids, this is your chance, we will help you. Get into the market. There was this sense of urgency to get into the market. Second, as I suggested, parents were sitting on a mountain of cash, and they say maybe some of this cash can go to the kids. And also we are seeing this huge, in fact, the largest transfer of wealth in Canadian history happening. And what happens is simply the parents of the parents, people in their 80s and 90s, are now dying. They are transferring, and so the baby boomers and the parents are inheriting this money. And they are basically seeing a situation in which this money is skipping a generation and going to the kids. And that will continue because there is a huge amount of money that is going to be transferred to kids. That's something that is going to happen. So this element is huge. And therefore, when you analyze the housing market in Canada, you cannot just ignore this as a marginal trend. 1/3 of first home buyers get a gift, a significant gift, and that's something that we have to consider when we look at price to income, the ability to get into the market, and the affordability issues. That's something very important to understand. And then there is another issue, which is the next chart. And that will be what will happen to the investment space in the market. We all know the story. Investors now account for what? 60-70% of new condos sales, and they account for a growing segment of the stock. So the question is it a good thing or a bad thing? How sustainable it is? So we released with Urban Nation a study just a few months ago, looking at inside the head of those investors, try to get the sense of what's happening. And we realized that about 1/3 of them are in negative cash flow. And I'm sure that many of you will not be surprised by that. And we tell them in, focus groups, why are you doing it? Are you crazy? You're losing money. And I said, no, you don't understand. First of all, somebody's paying me to finance my mortgage. That's one thing. But the most important factor and the most common answer that we got, very important to understand, is that they don't see it as a replacement for a GIC. They say, I want my son, 10 years from now, to have a chance to live in Toronto, or Vancouver, or Montreal. And if I don't get into the market now, they will never have a chance. And you know what? They are absolutely right. So if you try to analyze their decision to get into the market based on cap rate and interest rates and cash flow, you are wrong. It's not about that. It's not about economics. It's about future affordability for the next generation. Very important motivation that I think is playing a significant role impacting the condo market in large cities like Toronto. And then we have the next chart, which is, okay, interest rates are rising. What does it mean? Everybody's talking about how much debt people are carrying and what happens when interest rates rise. So let's start with the future buyers. You raise interest rates by 1%. This will increase your mortgage payments on average mortgage by about $250 a month. That's not insignificant, and that will slow down the market, and that will be a good thing. But what about people that are renewing their mortgage? As you know, every 5 years people renew their mortgage. Even if it's a variable rate mortgage, it's fixed for 5 years in terms of the term. So when you renew it, what will happen? And that's very interesting. So let's go to the last time interest rates went up, which was 2017. Let's go to the previous chart first. Sorry. Yes. And if you look at what happened in 2017, 18, when the last time interest rates went up, you can see that, yes, interest payments went up by very little, less than 0.5% of income. The effective mortgage rate went up by only 30 basis points, despite the fact that interest rates went up by much more. Why? Because everything is what happened 5 years before that. And 5 years before that, interest rates were relatively high. So any increase in interest rates in 2017, 2018 was not really impacting people because their rate was relatively high. Let's go to the current situation, which is the next chart, and we have the exactly same situation. Because remember, if you renew in the next year or two, you're comparing the new rates to the 2017, 2018 rates 5 years ago. And back then they were elevated. And I suggest that there is this buffer that interest rates can go up by 100 basis points before actually impacting anybody. So people that are going to renew their mortgage in 2022, 3, and 4 are relatively protected because interest rates 5 years earlier were relatively high. But people who took a mortgage in 2020 and 2021, and they will have to renew in 25, 26, they are exposed. And if rates remain high, they will feel the pain. But for now, for the next few years, the effectiveness of monetary policy will not be as great on people who renew their mortgage because they're already locked at a relatively high level. So that's basically where we are when it comes to the housing market. Now, let's talk about other real estate assets. The office. Of course, everybody's speculating what will happen to the office space. And the way I see it is the following. I will distinguish between Class A and B. That was 10 years ago. Since then, prices went up by 90%. So much for a bubble. This call for short Canada and a bubbly Canada is based on misunderstanding of the issue, which is the chronic lack of supply. This year, we are going to get 400,000 new immigrants. Next year, we're going to get 410. The year after, 420 or 425. Demand is not slowing. In fact, it's accelerating. The government, for the first time, as you know, Mark, admitting that supply is the issue. And they are willing to provide municipalities with about $3.5 billion in order to accelerate the process of releasing land and making things easier. But this money will be coming 2 or 3 years from now. So meanwhile, what the government is doing is actually encouraging demand while sitting on the supply solution. So in the short term, it actually will stimulate demand. So this is not a bubble. This is not a crazy market. This is not a crazy market compared to major markets like New York, Manhattan, like Berlin, like London. And I believe that part of the solution, as you know, is a rental market, a very strong rental market. Because I believe that we have to develop a mentality in which you are 35 years old, you are married, you have 2 kids, and you're renting, nothing is wrong with you, like in Manhattan, like in Berlin, like in London. I think that's the direction we are going, and purpose-built is part of it, and I think that's important. So no, this is not a bubble. However, with all the good fundamentals, accidents can happen. And that's why I spend about 20% of my presentation about the risk of a monetary policy error. Because, again, the enemy of the market is not rising interest rates, it's rapidly rising interest rates. So we have to make sure that interest rates are not rising too rapidly to derail the market. But this is something that I believe the Bank of Canada understands. And therefore, the fundamentals of this market are extremely strong. And those people who invest in condos now, because they want their kids to have a chance to live in Toronto, they know what they're doing.
Yeah, well,